Welcome back to the Wall Street Podcast. Today we're diving deep into the latest Global Metals and Mining Mini Primer. The second edition, actually. It was published by BofA Securities just on September 1st, 2025. Our goal here is to pull out the key insights for you on how these global metals and mining stocks really correlate with the commodities they dig up.
Exactly. And the report's core finding is, I think, quite crucial. It shows that while, yes, short-term correlations often hold, equities moving with commodities.
Right, the day-to-day swings.
Precisely. But over the longer term, company-specific strategies, think major growth plans or mergers and acquisitions, these can cause equity performance to really diverge, sometimes significantly, from the underlying commodity price.
So it's not just about tracking the LME or COMEX prices.
No.
Company actions matter a lot.
They really do. It's more complex than just a simple price link.
Yep.
And the report also brings up this concept of a revenue basket.
Okay, tell us about that. How does that work?
Well, for a diversified miner, the revenue basket is basically a weighted average price based on the mix of commodities they actually sell. Think of it as reflecting their real sales exposure.
I see.
And the report suggests this basket can be surprisingly effective. It can act as a signal, maybe spotting opportunities or mispricings, especially when the market might be turning.
Interesting. Okay, let's maybe dig into some specific metals. What about copper? What did the report find there?
Yeah, copper's a big one. Equities like Freeport FCX and Antofagasta, ANTO, they do show pretty high correlations with the copper price.
Which makes sense, given copper's run.
Absolutely.
Okay.
Copper's price has, well, more than doubled since the 2020 lows. A lot of that is driven by its role in the energy transition, EVs, renewables, plus tight mine supply.
And any outliers?
Yes, interestingly, KGHM shows the lowest correlation in their sample. The report attributes this to other factors, like the influence of the Polish zloty and also KGHM's significant silver production.
Right, diversification dilutes the pure copper link. Now, what about gold? Always a topic of interest. We hear some pretty bold predictions sometimes.
BofA strategists are certainly bullish. They're projecting gold could potentially hit $4,000 an ounce, maybe by Q2 2026.
Wow, $4,000. What's driving that view?
The report reiterates gold's historical negative correlation with U.S. 10-year real bond yields. That's the yield adjusted for inflation, and usually the U.S. dollar index, too.
So lower real yields are good for gold?
Generally, yes. And interestingly, Barrick Mining, ticker B, actually shows the lowest correlation to gold in BofA's sample. They suggest this might be due to its increasing exposure to copper.
Another case of diversification changing the profile. Okay, let's touch on industrial metals. Aluminium.
For aluminium, Norsk Hydro and Alcoa show the highest correlations with the metal's price. And BofA is quite bullish here, too.
What's their forecast?
They see aluminium potentially reaching $3,250 per ton by 2027. A key reason is the expectation of lower Chinese exports, mainly because China has caps on its production capacity.
Okay, so we've got these specific examples. Let's circle back to that core idea, the short-term versus long-term correlation. What's the key takeaway there?
Well, it really highlights that investors need a nuanced view. While short-term price moves off in line, the sustained company-specific strategies, like I mentioned, growth projects, M&A, they can really cause a decoupling over time. You can't just look at the daily commodity price.
Right, you need to understand the company's story, its strategy.
Exactly.
So that leads us back to the revenue basket. For an investor looking at, say, a big diversified miner, how can they actually use this concept? Is it a practical tool?
The report suggests it is. These baskets can act as sort of early warning signals for potential mispricings, especially near market inflection points.
Can you give an example?
Sure. Take Glencore. The report notes it underperformed its theoretical revenue basket for several years. Part of that was due to falling coal prices. But now coal prices are getting closer to marginal cost support, so the basket might suggest a potential shift or re-rating opportunity. And they also mention Anglo American, which recently saw a kind of catch-up rally towards its basket value, especially after receiving that takeover bid and announcing restructuring plans. So it reflects changing fundamentals or perceptions.
I see. It's like a benchmark reflecting their specific commodity mix. Beyond these direct company and commodity links, what about the bigger picture? What external macro factors does the report flag for precious metals, like gold?
Well, as we touched on, for gold, the big ones are U.S. 10-year real yields. That negative correlation is key. And historically, the U.S. dollar index, though that link can fluctuate.
And the thinking is, if central banks ease off on fighting inflation.
Yes, if they shift focus more towards supporting growth, that likely means lower real yields, which should in theory, support gold prices. The report also mentions that recent U.S. policies on spending and trade have actually been supportive for gold, alongside significant central bank buying, which reflects diversification efforts.
Okay, so putting this all together now, what does this analysis of metals, mining stocks, correlations, what does it mean for the broader economy, maybe for everyday life, beyond just our investment portfolios?
Well, you can definitely see the ripple effects. Strong copper prices, for instance, feed directly into the costs of making electric vehicles, building out charging infrastructure, solar panels, wind turbines.
So the energy transition costs more.
Potentially, yes. And aluminum prices affect everything from beverage cans to building materials, cars, planes, even gold's behavior. Its resilience, partly fueled by central bank diversification away from the dollar. That reflects underlying global economic anxieties about inflation, stability, which ultimately impacts consumer confidence, purchase power, how people think about their savings.
It really is all interconnected. This deep dive certainly reveals that complex interplay between commodities, company strategies, and broader macro trends. Understanding these correlations, and maybe more importantly, the reasons they sometimes break down, seems essential for investors.
Absolutely. And perhaps a final thought to consider, connecting this to the bigger picture. Think about how the ongoing global energy transition itself will continue to reshape these companies. It might fundamentally redefine what we even consider a pure play miner in the future, potentially pushing these traditional commodity correlations into, well, entirely new and unexpected territory.